BlackRock reported what nobody could describe as anything but strong earnings this morning. There's a lot there to please your investors. Earnings per share of $6.66, 125 basis points, possibly more, I think, of margin expansion. Assets under management of $6.3 trillion. And perhaps most impressive for a company of this scale, continued double-digit revenue growth.
Right.
But analysts were expecting a strong quarter, so it's fair to say the questions immediately are going to turn to flows.
Right.
Not just ETF flows, net inflows.
Yes.
Long-term inflows of $14 billion, the smallest for BlackRock since the second quarter of 2016. What's going on?
You did your homework. Thanks, Erik. Well, I think we said in our press release, it was a very good quarter. You went over the financial metrics. We saw clients worldwide pause. We saw clients they're confused. They're confused as to what direction the markets will go.
This is what they're telling you.
Absolutely, and I'm traveling everywhere, as you know. Clients are questioning the whole foundations of international investing, and that's the foundation of globalization. As we start entering this conversation about trade and tariffs, we're seeing clients pull back a little bit. They're waiting to see how does this play out. The backdrop is we have very strong earnings. Mm-hmm. First quarter we saw very strong earnings throughout the S&P. We believe we're going to see strong earnings in the second quarter. We're going at a rate of $800 billion of stock repurchases. We have record amount of M&A. So the backdrop is we're shrinking amount of equities. We have record earnings, as I said, and yet markets are essentially unchanged.
Does that surprise you?
Oh, absolutely. If you asked me at the beginning of the year, we're going to have record amount of M&A, record amount of earnings, and record amount of stock repurchases, I would have said the market would be up 10 to 12%. And markets are essentially flat. Now, if you strip out
So instead of the S&P 500 at 2,800, it would be more like 3,100.
Yes. More importantly, though, if you strip out the 7 major tech stocks that have done very well, actually the breadth is really poor. And we're seeing evidence of that. But let's go deep into the flows, because the flows really don't, the overall macro number doesn't tell you what was going on. We saw a lot of churn in our index equity business. And that's where we saw the outflows. We had about $13 billion of outflows in that area, very low fee things. And we saw investors pull out of what I would say emerging markets and other areas. And I need to remind you, cash for the first time since 2008, a little before that, is earning you a return. You're earning 2+.
Why is that important?
You could pause and earn money in the last 9 years.
People can afford to wait.
You can afford to wait. And this is a huge change in the marketplace in the last 9 years. And people have forgotten about that. You're earning almost 2.5% now in a money market fund. That's pretty similar to the 5-year Treasury. You could pause. And by the way, equities are not up 2.5%. So you could be earning money in cash and pausing. Let me get back to the flow.
Hang on a second. Should people be pausing? Does that seem like
I actually,
a wise, smart thing to do right now?
It depends. If your horizon's the next 5 years, it's probably good to pause. If you're focusing on your retirement and your pension fund, you should never pause. You should be continuing to invest. So it really depends on the time horizon. We saw $4 billion between flows and commitments in alternatives, in our liquid alts. We had $8 billion in flows in our multi-asset. So if you break out all the flows, right, positive flows, and
money's going some places, money's coming out of other places.
But we've seen huge churn, and if you strip out the index business, which is virtually low fees, our flows were better than what the headline is, because we had about, as I said, $13 billion of institutional outflows. In iShares is a very good example of where you saw a real decline.
The ETF business.
Yes, in the ETF business. We saw a dramatic slowdown in May and June. We're starting to see an uptick now in July. We're starting to see more flows into it. But our view is the ETF growth, and we anticipate $10 to $12 billion by 2023. So we still expect $10 trillion.
In total ETF market.
We expect ETFs to continue to grow for 4 reasons.
Okay.
Reason one, ETFs represent a great value. ETFs are becoming more and more of a great trading instrument. There was a great articles about fixed income. I've been telling you about fixed income ETFs at least for 5 years, and now they're starting to catch on. ETFs are now being utilized for alpha tools. So many investors using ETFs to get exposures. And then most importantly, the biggest trend, and that trend is continuing, we're seeing ETFs being utilized by more wealth management as we see the transition from brokerage to fees. So we believe the future growth of ETFs will continue.
Larry, can we go back to the investor sentiment for a moment?
Yep.
What is it? You say investors are confused. What is it that confuses them? Well, and how would you describe the sentiment?
Well, the market performance is validating that confusion. As I said, the fundamentals are incredibly strong. We're going to have a 4+% GDP economy in the second quarter. As I said, record earnings, record stock repurchases, record M&A. That's like nirvana for investing, and yet markets are unchanged. And so the market's having a hard time digesting the whole change in globalization and trade. And I believe this will continue to be a big issue until there's better certainty. And you know markets hate uncertainty.
Okay, well, we've heard uncertainty a lot.
Yeah.
10 years. How does the uncertainty today compare with the uncertainty that investors have known since the financial crisis?
Well, there wasn't. After the central banks of the world stabilized the banking system, I would say there was less uncertainty. We obviously had Eurozone issues. We have all these various issues.
Regulatory issues here in the United States.
But in my 42 years of investing, the one thing I felt certain about, and that is globalization is good. And international trade is very good. And we are now raising those questions. And I think the foundations of international investing are being raised and being questioned. And I think until we have better understanding about this, you're going to see clients pause, keep their money in cash, keep their money in low duration bonds, keep their money in unconstrained bond funds. Maybe if they see a great alternative product, they're going to continue to do that. But overall, clients have a wait and see attitude.
What about your attitude? How would you describe your state of certainty?
I think these are important questions to be answered. And
but do you feel more uncertain than you felt at any other time in the past 42 years?
No. I mean, but I feel in the last 5 years, do I believe this is a more uncertain period of time? Yes, I do. And look at the question I'm raising is this 1994 when the markets were very concerned about growth. Actually, the Federal Reserve, you remember, eased when they should have been probably tightening, and so they got it wrong too. And then the market reasserted itself, and we had a 5-year bull market. We may be in that position. The market may be wrong right now in that GDP will continue to grow. The trade conversation is not that difficult for international commerce, and M&A and share repurchase will continue. If that's the case, we'll wake up in a year from now and the markets are going to be up 10 to 12%.
Flip side?
Well, if we have a true tariff wars, we'll see the markets down 10 to 15%. So I do believe...
You wouldn't call this a tariff war?
We haven't... No. We'll see what happens in the next $200 billion proposal that the U.S. government has done with China.
Between now and the end of August.
Yeah, so right now it's talk. Let's see if there is a resolution on that.
Why aren't tariffs on $50 billion of Chinese goods and tariffs on steel and aluminum imports and tariffs that are being imposed on the Europeans with retaliatory tariffs on U.S. goods, why doesn't that constitute a trade war?
Well, it is a minor trade war, but it has very little impact on global GDP. It's just too small yet. But symbolically, it is having an impact. It's having an impact on investor sentiment. And that's what we are seeing right now. We are seeing investors pausing until there's greater certainty.
We talked about stocks. What about bonds? You mentioned that you can earn north of 2%.
Bonds are fine.
In a money market
keep in mind, bonds are not this one-dimensional product. Do I want to be in long duration bonds now? Probably not, but I could be in low duration bonds. I could be in cash. I could be in other types of products. I could be in credit, low duration credit funds. So you're being paid now to take some risk in the short end of the curve. And the question is, are you being paid enough in the long end of the curve? And I would say probably the long run, no, you're not. I am
at 2.8% on the 10-year. You're not being paid enough.
Compared to that, I could earn 2.5% in a money market fund. No.
What about the inversion of the yield curve?
I've been talking about this for 2 years. I think we will see an inversion of the yield curve.
When?
Sometime this year. But I don't believe it means we're going into a recession.
Why not?
Because we have a Federal Reserve that has already stated they're on a path for 2 to 3 more tightenings. We have an ECB that has stated that they're not going to do anything until November, December 2019. We have a Bank of Japan that has stated the same types of paths. So we're going to have a huge diversion between U.S. interest rates and European and Japanese. And that's why the dollar is strong. And so we're going to see more flows into dollar-based assets, mostly, in cash and low duration, and that's exactly what we're seeing.
Okay. So, but again, I'm having difficulty taking all of these discrete pieces of information and adding them up into a picture that tells me something. Where do you think we are 2 quarters from now? Where are we at the end of the year?
Well, we believe at BlackRock that 2018 will be a strong year GDP. That is mostly because of tax reform. We believe in 2019 the U.S. economy will begin to slow down. Now, if we do implement this $200 billion tariff war between China, I think all bets are off.
Meaning what?
The GDP will slow down dramatically. We will have even more uncertainty about the world and how the U.S. is being portrayed. One thing I will say...
So hang on a second.
Yeah.
The U.S. imposes tariffs on an additional $200 billion of Chinese goods, right? Could happen by the end of August.
Yes.
That's going to cause GDP to slow down dramatically, you say?
In 19, yes.
And that's going to do what to financial markets?
I would say financial markets would go down in that scenario.
So, given all of this...
Yes.
How good a job? The economy is growing, you say, at possibly 4% or faster this quarter.
Yes.
How good a job is the president doing managing this economy?
In the short run, the economy is doing fine. Look, I'm a globalist, Eric. I believe in the foundations of how the U.S. has built its relationships.
Why put all these things at risk then?
The president has a different agenda than I believe is the right agenda at this time related to trade. I do believe we should reevaluate our trading treaties with some of our partners over the, some of these treaties are very old. It's time to reevaluate them. I would do it in a much more private way. I would work it out. I would treat my my global partners and allies with the idea that we can work it out together.
Okay, that's not the approach that the president has taken.
No.
Once upon a time,
and the markets are showing that. That's why the markets are virtually unchanged.
So, once upon a time, you sat on a council.
I did.
That Steve Schwarzman chaired, that advised the president. That council has since been dissolved. Do you have channels through which you can communicate these concerns to the president or to members of his administration?
We certainly have open channels to talk to anyone we wish to worldwide.
And what are you doing about it? Or how are you communicating these things? Isn't it important, if you believe, as you say you do, that these things matter, that they have consequences for the economy, that they have consequences for investors, they have consequences for the wealth of Americans, and furthermore for the wealth of your clients and constituents around the world? Surely you'd want to do something about it.
Eric, markets will speak louder than what any one single voice. I mean, we have channels. We do go through our channels. This week I'm talking to members of Congress on many things. So we have an open dialogue, and we are, last week we spent time with other countries and had open dialogue with other leaders of other countries. So I could rest assured we are having conversations, but unlike some people, I'm not going to talk about them.